this week's market update, China's growth rate slows, the UK flirts with recession, but Wall Street powers to a new high on rate cut hopes. China's economy is growing at its slowest rate in nearly 30 years as the trade war with the US starts to have an impact on exports. Despite ongoing trade tensions, China's domestic economy remained resilient in the 3 months to June, keeping overall growth above 6% and confirming a shift away from manufacturing and exports to a more service-based economy. Activity grew by 6.2% year-on-year in the second quarter of 2019, which was bang in line with expectations, but the slowest pace of growth since China's National Bureau of Statistics began calculating the GDP data in 1992. Last year, China grew at 6.6% for the year as a whole and by 6.4% in the first quarter. China has already moved to support its economy in anticipation of a trade slowdown. Tax cuts and loose monetary policy put a floor under domestic consumption and offset the impact of tit-for-tat tariffs that have soured the relationship between Presidents Trump and Xi in recent months. There are doubts, however, about whether China is prepared to act more decisively to prop up growth in the way that it did after the financial crisis and again in 2014-15. High debt levels are a concern, and the government is trying to tread a delicate middle path between stimulus and fiscal prudence. Worries about trade lay behind a modest stock market correction in May before signs of a truce at the G20 summit in Osaka last month helped push shares higher again. Trade is clearly one of the biggest drivers of stock markets at the moment, alongside interest rate expectations. It will be interesting to see whether the relative resilience of the Chinese economy emboldens Beijing to dig in for a long trade war with America. Both sides have seen their economies hold up strongly in the face of the ongoing trade spat and may feel justified in pursuing a hard line in the continuing negotiations. For both the US and China, the trade dispute is just one front in an ongoing battle for strategic dominance of the 21st century. If the strength of their respective domestic economies allows them to continue challenging external competitors, then so much the better from their perspectives. Delving further into the numbers, there was a pick-up in retail sales growth in China as consumers continued spending in the face of the negative trade headlines. Manufacturing also picked up, growing at 6.3% compared with 5% in the year to May. Property investment, however, slowed a bit, growing at 10.9% compared with 11.2% a month earlier. Closer to home, the UK economy is also under the spotlight this week, with a series of data releases that will shine a light on the dilemma facing the Bank of England as it moves towards the first anniversary of its last move on interest rates. That was a quarter-point hike last August, which threatened a new tightening cycle but was unable to deliver any further rises as Brexit-related uncertainty tied the bank's hands. Rising inflation was the key driver of last year's hike, but prices have moderated since, with CPI falling back towards the bank's 2% target. The consensus view is that inflation will hover around the target rate for some time to come. This, in turn, poses questions for the bank because household earnings are currently rising much faster than prices, raising the risk of a wage-fueled increase in inflation. However, the mood music around Brexit is pointing the other way, with the risk of a damaging no-deal exit seemingly rising as both candidates for the Conservative Party leadership, Jeremy Hunt and Boris Johnson, make the case for leaving on or before the 31st of October. Although GDP figures have held up so far, the bank has made it clear that it's prepared to cut interest rates again in the autumn if needed to support the UK economy. The consensus view of UK economists is that the next move in UK interest rates, like America's, will be down. That outcome was given more credence this week by the Resolution Foundation think tank, which said the UK's recession risk was the highest since 2007. It warned that with interest rates close to zero, QE having lost its power, and with high levels of public debt, the options for fighting a recession were now more difficult than in previous downturns. Meanwhile, in the US, the market mood continues to defy gloomy headlines as the S&P 500 index closed above 3,000 for the first time at the end of last week and made a modest further gain again on Monday. Shares are edging higher as investors bet that the Fed still has the power to support the economy and set the US back on a growth trajectory in the second half of 2019. Although interest rate hopes are supporting shares, investors remain cautious ahead of second quarter earnings season, which kicks off this week with the usual flurry of financial company results announcements. This week we hear from Citigroup, Goldman Sachs, JP Morgan Chase and Wells Fargo. The second quarter earnings reports will show whether the US is on course for its first earnings recession, that's 2 quarters of declining profits, since 2016. Profit margins have been rising steadily for years, and investors fear that the factors driving that shift in power from labour to capital may have run their course. Rising labour costs are an increasing concern for businesses after years in which workers have played second fiddle to shareholders. Earnings season will also provide some guidance on whether the US is heading towards its first economic recession since the financial crisis. That's not most investors' central case, but it's a nagging doubt in many market participants' minds. The prospect of a recession has been raised in recent months by signals from the bond market, where longer-term yields have fallen back to roughly the same level as the income from shorter-term instruments. This so-called flattening of the yield curve is a widely watched indicator of economic trouble ahead and has preceded all recessions in recent decades. There was actually good news on that front this week as the yield curve steepened by the most in almost 3 years, as investors showed greater optimism that the Fed will indeed keep the US economic show on the road. The difference between the yield on 3-month and 10-year Treasury bonds turned positive on Friday. That reflected relief after a strong set of employment figures the previous week and an uptick in inflation data last week. Both of these point to a stronger economy than might be implied by the Federal Reserve's currently cautious stance. We'll find out in 2 weeks' time how the Fed's thinking is evolving, with the next meeting of the US Central Bank's Rate Setting Committee on July the 30th and 31st. The expectation remains that rates will be cut this month and again before the end of the year, with possibly a further 2 quarter-point cuts in 2020. The big question facing markets is whether cheaper money can offset the impact of weaker growth. History suggests it's growth that is the bigger influence in the longer run.